So, you want to start investing, but you have no idea where to start. Welcome to Hustle Libraries. Today, we will get into stock investing and cover stock basics, different investing strategies, and tax. Let's get started. Investing can be overwhelming for beginners. You have several investment options to consider: real estate, bonds and securities, fixed interest like CDs, savings accounts, or other bank products, gold, crypto, insurance products, mutual funds, and equities. These are stocks, ETFs, and stock options. So many options to choose from, but let's get into stocks. Like, how do you actually invest in stocks? To start, you need to find a brokerage. A brokerage is simply the middleman that connects buyers and sellers in the stock market. In the past, things weren't easy for the little guy to buy stocks, but now it's the easiest it's ever been to get started. Brokerages like Robinhood and Fidelity have changed the way we invest in stocks forever. These days, it's easy to invest right from your phone. Transactions are commission free. And the best thing of all is that you're able to invest with as little as $1. There are several exchanges where you can trade on, like the New York Stock Exchange and the NASDAQ. An exchange is simply a market where stocks are listed and exchanged. Different stocks are listed on different exchanges, and some are US-based exchanges while others are specific for other countries or regions. Most brokerages will let you invest in most of these exchanges. You don't need different brokerages to invest in different exchanges. Next, what kind of stocks can you buy? Well, you can invest in stocks of individual companies like Coca-Cola, Tesla, or Apple, for example. But fair warning, investing in a single company comes with its risk. If a company goes bankrupt, it's possible you can lose your investment. So, it's imperative that you do your research before you start investing. If you don't want to invest in a single company, you can also invest in index fund ETFs. Think of these as a basket of stocks. For example, if you invest in an S&P 500 index, you are actually investing in the 500 companies the index tracks, which are across 11 different sectors. Like any investment, index funds still come with their own risk. But to lose your whole investment, every company the index fund tracks would need to go to zero, which is not very likely. Investing in index funds is generally less risky, but you should expect on average a modest return on your investment. Investing in single companies comes with a higher risk, but a potentially higher reward. Consider this when deciding which type of stock to invest in. Do you need to look at stock charts all day to do this? Investing can be as hands-on or hands-off as you want to make it. There are different strategies for different people. There are day traders. These people buy and sell stock in the same day. There are swing traders. These people buy stock and sell it within a few days to a few weeks. There are long-term investors. These people buy stocks and hold them for years, even decades at a time. Last, there are people who invest in stock options. These people do not buy stocks. Instead, they purchase contracts that give them the option to buy or sell stock at a specific price within a predetermined time. This can get very complex, so we will explore this further in a future video. Stocks do not need to be complicated. The basic principle is simple. Buy low, sell high, and the difference is your profit, which is also known as a capital gain. The different investing strategies result in different tax treatment. Holding a stock for 1 year or less results in a short-term capital gain. Short-term capital gains are taxed at your ordinary tax rate, which can be up to 37%. Depending on your specific tax bracket. This is the same tax rate you pay on your personal income taxes. Holding a stock for more than 1 year results in a long-term capital gain. This tax rate can be 0 15, or 20%, depending on your income. Here are the long-term capital tax rates for 2020. For this to make more sense, let's look at an example. This is Bob. Bob buys 100 shares of XYZ stock at the price of $10 each. His total cost is $1,000. 9 months later, XYZ stock price jumps to $20 each, and Bob sells his 100 shares for a total of $2,000. To calculate profit, we take the sales price of $2,000 and subtract his cost of $1,000 to get a $1,000 profit. Since he held that stock for 1 year or less, he will pay an ordinary income tax rate on it. Again, this can be up to 37% depending on his tax bracket. If he held the stock for 1 year and 1 day or more, his tax rate would be 0, 15, or 20%, also depending on his tax bracket. You only need to pay taxes on profits when you sell. So let's say that after 25 years, XYZ shares are up to $200 each. Bob's 100 shares are now worth $20,000. Even though his investment is up $19,000 in profit, he will not have to consider taxes until he actually sells his shares. This is known as an unrealized gain. If Bob sells his shares, he will have a realized gain, and he'll have to pay tax. We've covered stock basics, investing strategies, and how and when profits are taxed. This should get you started on your investment journey. If you're looking for a brokerage for beginners, I'll post my Robinhood referral link below. If you use my link, you and I both get a free stock worth up to $500 in value. Robinhood is good for beginners as their platform is very easy to follow and they allow you for fractional trading, which means you don't need to buy a whole stock. You can invest as little as $1. Alright guys, thanks for watching. Consider sharing this video with somebody who might find it useful. And as always, drop your questions or ideas for future videos below. Until next time.